Hello, everybody. My name is Bruce Curry. I'm the Vice President for pre-sales on collections and recoveries across EMEA for FICO, Fair Isaac Corporation. This webinar today is just to run through some content around customer-centric collections, why they're necessary more so now than they possibly have been in the past, and it's not as though they haven't been an area of focus in the past, and to talk about what we at FICO are often seeing, what we should see more of, and what we hope to be seeing in the future when it comes to the ability to manage and appropriately treat and resolve debt problems with good customers in bad circumstances. Should take about 20 to 30 minutes, and hopefully you'll find some of the content of use. What I normally ask for when I do these webinars, especially if I'm in a live audience, is for nothing more than just to ask themselves, as I mentioned, capabilities and enablers and competencies that are necessary or critical to achieving the right outcomes for customers in financial difficulty, is for the audience just to ask themselves and their colleagues around the table or in the forum, we do that, don't we? Or are we sure we do it that way? Or could we do it that way? So it's more just is there anything worth taking away that's a checklist against where we are? The customer charter around customer centricity for collections is a slide that I dug up from 2014. And so, it's quite clear that customer centricity isn't new. It's being reinforced. Treat the customer fairly in the UK came out many years ago. Driving the right outcomes has been a focus at least for the past 5 years. And then we've had subsequent regulation come in, the likes of breathing space, persistent indebtedness, and many, many other areas of focus around doing the right thing for the customers. But more than just the regulatory side of it, the customer-centric collections capability will improve both the retention of good customers in bad circumstances, and it will also enable for far more efficient and effective collections results. So why is it a hot topic now? Well, in reality, the regulator is ensuring that it's a hot topic, and with the backdrop of the last 2 years, which gets mentioned at just about every event and every conference now, there's going to be, or there's an expectation that there will be a significantly increased demand for debt resolution with a higher proportion of the creditor customer base over time. On the regulation side, I've already mentioned breathing space, and we know that breathing space hasn't really been that adopted as yet by the mainstream first-party creditors, but it has seen some traction in the third-party space and certainly in the debt management company space. But even there, it's been quite low in volume versus what the industry expectation was at the outset. And so we're still to see whether breathing space has a significant impact and is used as the tool it's supposed to give that 90-day freedom to resolve matters before further collections action takes place. Persistent indebtedness has been around for a couple of years now, obviously got significantly interrupted over the last 2 years with the pandemic, mainly driven by the then payment holidays and different forbearance and kind of financial stress solutions being applied, and more tolerance certainly. And so more people will probably will be moving into that space of needing to make minimum payments on their credit cards over time. As inflation determines, we've got lots of things hitting us from the utility bills, energy costs, inflation. We're just about at this point in time in 2021 to go into another set of restrictive kind of requirements over COVID. There's going to be a lot more requirements for people to be living on credit over time. And as we say, the regulation around right outcome has been around for quite some time. And then we've got the expectation. Our customers expect that our banks and our institutions will know quite a lot about them. There's smart meters out there that know about the water I use and the energy I consume. Open banking can give insight into all of my transactions. I don't expect any longer to be speaking to specific departments. I talk to the entity, and I hope that the entity is sophisticated enough to have pulled all of my information together and be able to utilize that information to help me in my inquiry with them, or in my dealings with them, or whatever specific customer journey I'm on. Let's face it, the customer themselves has the experience of having everything about their life contained on the one phone they have in their hand. And they see that as a small computer with a lot of capabilities. So there is an expectation that big institutions with big computers and IT and technologies will utilize those to know more about the customers. They expect you to have information around their social side, their work side, their services side, their finances side. Not necessarily that all institutions will have all of that information, but if that information is relative for my dealing with that institution, then they typically would expect them to have that information. And they get frustrated when we don't know things about them, when we don't know on the credit card collection side that they've got a mortgage, or we don't know in the mortgage side that actually they were on a forbearance treatment previously and they paid that down and resolved their debt problem 3 years ago, or that on the unsecured personal lending side that the car is critical, secured lending side, the asset finance side, that car is critical for their job because they mentioned that as their reason for needing the loan in the first place. So how do we use all that lifetime data and that cross-enterprise data across my product holdings with you to make sure that there's a good overview and a good understanding of what the customer's circumstances are and were when we last spoke to them, and when they're enriched with new customer data, can I use all of the data that I've gathered, internal, external, third-party data from the call, to manage that customer effectively? And then I've got the technology side. Everything's remote nowadays, been more remote for the last 24 months than it's ever been. And it's voluntary remote as well as enforced remote. So people are getting used to the fact that the technology is there to connect me up to everything I need to do. I can run my life without needing to leave my office or my home. And for the business side, we should be able to provide this customer-centric. Everything now is going cloud enabled, and that layers capabilities to allow for the servicing of use cases. And when you're talking about use cases, then you're typically less about point, standalone, isolated, siloed solutions, and more about integrated decisioning and workflows informed from a myriad of locations across the enterprise. And with APIs and microservices, all of the technology is there. But no longer do we have the constraints where the IT department are the guardians of capabilities. We now have business users having access to capabilities in the cloud, software as a service solutions that enable them to configure and control, still go through the rigor of the relevant governance on testing and user acceptance and all of those requirements and the compliance side, but very much the technology allows for agile, fluid, integrated, non-siloed environments. And many organizations are moving towards that. I think one of the most common phrases used at the moment when you ask somebody what they're focusing on, they'll say somewhere in their paragraph, a digital strategy. And that's a real kind of overhaul of all the technical side. And then the finance have gotten much closer to the collection space. They now know where the department sits and what we do. And the reason being is that IFRS 9 reporting has come in. It's been mature now for coming up to its second year in most countries where it's applied. And although it got some disruption through the last 2 years and there was some tolerance about interpretation, the fact is that being inefficient or ineffective in collections now on accounts that, if worked efficiently and effectively, would cure within the first 30 days and resolve, well, then you're leaving yourselves open for a stage 2 or stage 3 IFRS 9 ticket, and that will cost money, whether that's for a probationary period of 6 to 12 months on a stage 2 or for the product life on a stage 3. There definitely needs to be a focus, and there is a focus of CFOs now understanding the cost of either inefficient, ineffective, or over-tolerant collections, and asking, how am I supposed to hold that impairment on the balance sheet? How are we supposed to price competitively in the market when we've got to cover this level of provisions and capital adequacy? So it's a constant conversation that's getting louder and louder, and actually we're getting a lot more occasions where the CFO is equally, if not more, interested in a collections initiative than the CRO, the CTO, or the head of operations. And why else should we do it? Well, we have to, says the regulations. We need to, because there's a customer expectation. And you'll see I've written on here, and we can. So the technology side. anything that I mentioned in this webinar isn't blue sky thinking and hoping. It's not on a drawing board or a wiring, just a basic wire diagram. It's actually in place. So this isn't a case of the need is driving the innovation. Most of what I'm mentioning as capabilities here already exist and are utilized by the lead organizations in the collection space. And that's not necessarily just in the first party space. It might, as I say, be with the debt purchasers, the third party contingency servicing part of the industry. It may be with the not-for-profit sector and the debt management companies. All of these organizations have access to and can utilize and adopt technologies that are out there. Many of them are on a path to doing so. All are at different degrees of sophistication, but the fact is nobody needs to be waiting around for inventions to come and solve these problems. Everything we talk about today is already proven somewhere and in some market, if not in our own. I'd like to walk through the kind of things we see typically. We engage with hundreds of clients across the region on a regular basis through our consulting division and through our pre-sales and our sales colleagues and our solution implementation experts and consultants. So we have a lot of engagements where we're constantly seeing how our clients manage their collection space across all of those sectors of the industry I mentioned, as well as what they use to do so. So we also, with the analytics teams and our optimization teams, also get a really good feel of the data that's being used, the analytics, the insights, and how they're being leveraged. And the reality is that we often see basic analytics. And what I mean by that is that we see originations and customer management behavior scores being used to determine the collections treatments. That behavior score, it is built up of a history that was relevant to where the customer was, not where they are now. And many customers, especially in an economic downturn, are surprised to be in collections, don't know what to do when they're there, and aren't sure what the processes and the protocols are. And basic analytics, if it's just predicting their likelihood of rolling to default, a 6-month window out with minimal information from the customer and just using a historic behavioral score can actually route accounts quite badly to the wrong place. I didn't say that very well. It can inadequately route accounts to where they need to be to get the appropriate treatment as per strategies for different risk segments, etc. We see, the product level view is what we typically see more and more often with a customer level view, but it's still a product level treatment. And that's fine, providing there's a customer level view in place. Too often we just see a product level view. I think that's the point here, where there is no wider view of the customer. And that can be a significant hindrance and really calls into question how you're managing to meet some of the things like IFRS 9 reporting or the regulatory. How do you assure that you've driven a right outcome if you can't see the information that's necessary to get a 360-degree picture of the customer? Campaign structure, most organizations are still working on that. Campaigns, batch runs, 30-day redecisioning periods, and everything being about a big chunky campaign. In fact, in some places, it's very much that the dialers become the decision engine. It's just big campaigns being run through a dialer, and it's resource availability and dialer operation during call center operating hours that has over time become the nerve center running the collections shop. And that's actually not a great place to be. We see a lot of multi-channel, not omni-channel, and so you can't get the integrated messaging that you're looking for. And people are just literally, here's a file that goes out to the SMS aggregator, here's a file that goes out to print, here's a file that goes to the dialer, but messaging between the two and the sequence of the messaging can't be orchestrated, and therefore it's more like a hectoring kind of customer engagement strategy rather than a dialogue customer engagement strategy. This next one is a real concern of mine. It's policy rules okay. And what I mean by that is that quite often we use policy to overcome our insights ignorance. So if we can't get insights to the desktop, then we put policy rules in place, especially where we've got large collections operations. Let me give you an example. Collectors can do a settlement up to 20%. I can only take 2 arrangements in a year. and no arrangement can be more than 3 months. We only do a promise to pay for a maximum of 7 days out. All these policy rules is because what I can't see is that actually for Bruce Curry, with this debtor position needing to be resolved, and he's got a credit card with me, and I notice he's also got a car on contract with us, on contract hire. That's interesting. The policy says I can give him an arrangement. Well, he's had 2 arrangements, so I can't give him any more. But hold on, Bruce has been with us for 13 years. He kept all the payments on those 2 previous arrangements. Actually, is it an arrangement he needs, or is this shown that it's actually a longer term situation? And have I got the forbearance solutions and instruments, and can I calculate them, and can I use data to validate that actually what's the right type of restructure that Bruce wants over time? Typically, policy rules prevent me crafting the right type of solution for Bruce. In a recent conference I was at, a lady gave details of how she'd been impacted. She was a financial advisor by trade, and she'd been impacted over the last 2 years because of the pandemic. And she talked through how her very sensible 6-month salvage budget, safety network, financial safety budget that she had put away with her husband for years, they'd kept this top up of 6 months. She talked about the sequences following her husband being made redundant, how that then impacted, and then unexpected expenditures that came in, and how decisions compounded decisions, and those decisions compounded the finance, and actually the 6-month safety budget reduced to just 1 month in a period of just 2 months. What was clear was she then asked the audience, how many of you would have known all of those things about me? She'd listed out these circumstances. Nobody put their hand up. The fascinating part was that she then put a slide up that showed all the data that could have been obtained without even speaking to her to inform a creditor of what her circumstances were and how badly it had impacted her. But then we had a discussion about it, and actually most organizations' policy rules would not have allowed them to cater for her particular circumstances and needs, and the forbearance solutions and tools that people were needing or utilizing were probably insufficient and inadequate. We don't see enough of cycle-specific predictive analytics, so predicting what's going to happen, not just from one billing cycle to the next billing cycle, but even within cycles, within collections and recoveries. A digital strategy will be between 5 and 10 days typically. So where am I redecisioning between 5 and 10 days before I go on to potentially more agent-driven internal strategies? And then how long am I going to do that for? Am I doing it for just 20 days to make me up to the 30 days, my nice usual 30-day windows that I look at? Or am I saying, do you know what, after 7 days on those agent-driven strategies, I should be then reconsidering again what I'm going to do. So can I get to contingency as soon as 27 days out from when the account first appeared in collections? Is that appropriate in some circumstances? And how can I facilitate that? But I don't have the insights and I don't have the analytics to tell me whether that is an appropriate treatment for one particular customer in a particular set of circumstances. We don't see enough of a customer-centric view. We don't see enough of them decisions being made and agent desktops being informed by events, whether that's events that are being registered at the bureau or events being registered somewhere else in the enterprise, whereby there's a loan application that's come in through customer services. We're focusing on the mortgage, but we didn't realize that actually they're being offered a credit limit increase on the credit card. We just don't have enough information of the events we're triggering, the customer's triggering, or third parties are triggering. We're not capturing them and using them and channeling them to us in the collections space where we can use them to determine the next best treatment. Engagement, we don't have customer-centric engagement, typically because we don't have the omnichannel platforms in place, or where we don't have the omnichannel platforms in place, we can't get away from hectoring. We can't get to a dialogue through a day that escalates through a day across multiple channels that allows us to utilize differential channels to increase the potential for customer engagement and customer servicing, and the customers aren't able to select and choose the channels that they need to undertake auto resolution and self-serve. And if you haven't got that integrated omni-channel capability in place, you'll still be doing an awful lot of heavy lifting through the most costly resource possible, which is a large agent workforce. And most of the early collections does not need, and when I say most, anywhere north of 65 to 70% does not need agent involvement. And then the other thing we don't see enough is we don't see enough of reason for delinquency, duration of impact, and disposable income related forbearance. So we see policy rules, as I mentioned before, saying you can have this option or that option, but we don't see data being fed. We see lots of different types of income expenditures. Some of them are linked up to the standard financial statement. Everybody's kind of following the principle of the standard financial statement and should in the UK, but there's lots of other variations of out there that the creditor considers satisfy those requirements, not necessarily using the trigger figures that are available, certainly not using trigger figures that are available from their own large portfolios that tell them how their customers in the demographics they target to acquire and market to, how their trigger figures should be informing the back end in collections. And we don't see the forbearance calculators driven in any kind of sophisticated optimization way. It's typically a policy-driven Excel spreadsheet approach to forbearance. What we hope to see, and again, none of this is blue sky thinking, all of these capabilities are available and are utilized in many industries, even if they're not utilized in the collection space. Real-time prescriptive decisioning. So it literally is driven when those events are recognized and triggered, they trigger the next decision. If somebody comes through on a forbearance requirement, so they're saying they're in financial hardship, I'm gathering information from them. They give me permission to reach out to open banking. I source that, that comes in, it populates, all the categories of spend are categorized. It's all happening behind the scenes in microseconds whilst I'm still talking to the customer. And then by the time I get to the point of, right, so let's see what we can do for you, I've got huge amount of information on them and I'm very clear on where they are. I've validated it. I can understand their disposable income. They've told me the reason that they're in these circumstances, and they've told me the likely duration of the impact of these circumstances. And now I can truly start to shape a proper forbearance solution for them. I've got deployed in the background true artificial intelligence and machine learning models that are giving me the predictions of probability of take up, the probability of default of the forbearance solution that I'm utilizing, and in fact will optimize it down of the, let's say I could offer 17 different variations of forbearance. Actually, it gives me the 3 that this customer can best afford and equally afford. These all fall within a certain targeted default rate, so I know I'm not giving them something they're going to fall over on or shouldn't fall over on, high probability of success. And I also know that one of those particular options, despite the fact that all 3 are perfectly suitable for the customer, one of those has a better positive NPV for my portfolio performance. So I can actually do right by the customer and do right by my organization. We hope to see more of those competencies at the desktop in utilization, and actually the policy document reducing right down to simply being an instruction of please follow the screen. Bi-directional auto resolution I've mentioned, omni-channel, we hope to see a lot more take up and utilization of that, the omni-channel. And again, customer engagement is a big area for optimization. That's where the scale and the volume is, and that's where if you can plug that down and you don't get significant roll rates, you'll be making collections a competitive space. Stronger links between the first and third party to target operating models. Insufficient data is passed from the first party creditor to the third party creditor. Just enough information for them to start collecting on a debt. And it's not really helpful yet. The customer's already passed lots of information. They've explained why they can't pay. They've explained their circumstances, and then they have to start all over again with the contingency placement sector or the debt purchaser who's having those debts serviced. And likewise, the third party returning accounts with uncollectible. We still see that far too prevalent, or that's still far too prevalent. And if they've had dialogue and they've captured information, why is it uncollectible? What is the reason? Why can this customer not be helped? And when will it be collectible? And how can we put some analytics and predictions around that and some validity? So there's still some stronger links to be made, and also the automation. A lot of organizations using the likes of Placements Plus, TDX solution. There's several other solutions coming to market, but some have been, Qualco have got a solution of placing accounts with third parties and being able to do that real time backwards and forwards. But there's still organizations that are not utilizing that to its full extent. Dynamic forbearance I've talked about, being able to flex the instruments of interest suppression, arrears amortization, term extensions, balloon payments, settlements. There's the ability to do really dynamic forbearance, and a lot of organizations are stuck with just term extension, and that's all they'll consider. And as I say, one policy. And again, this isn't new stuff. It's not stuff waiting to be invented. It's stuff that's available because we can. We see institutions, a small handful of institutions, doing everything that we hope to see many more institutions doing. And what gets truly impacted? Well, the customer gets impacted because they're getting a treatment they weren't expecting. They remain loyal. They will return to the bank if the bank has a policy that says when you've resolved all your debt problems, you're welcome to come back, and that's becoming more prevalent. Seeing more outside the UK at the moment than inside the UK, but I think it will take hold quite strong over the next couple of years because it will need to. All those good customers that can't help being where they are financially today because it's been driven by the economic downturn of the last 2 years, triggered by the last 2 years, and will continue into the next couple of years, they are not bad customers. And so once they resolve and once they get on an appropriate footing financially and return to being good financially stable customers, why on earth would we not have them back? And talking to colleagues around the industry, that mindset is opening up. More people are challenging their internal policies around never again shall a defaulted customer darken my door. That's becoming really old hat and quite sneered at really as a, really, you're still there? The organization itself needs to get behind customer-centric everything anyway, and is doing so. And a golden record, single version of the truth, one customer, 360 degrees, being able to service them and manage them digitally in the round. It's all across the organization. We need to make sure that collections isn't out of step with those capabilities, but also contributes to them. Collection, a lot of the organization does not get as much customer engagement as collections gets with its customers. So if you really want to know your customers, the ones you'll know best are probably those that have been in the collections area. Otherwise, their mortgage is run for 20 years with never a phone call received. Their credit card is either on minimum payments for the 18 months and then moves, or it stays as a transacting account with no minimum payments, and you never hear from them. They just accept the credit limits when they're offered. The car went out on a loan. You hear nothing about it until that final payment comes in. Many parts of the organizations do not have frequent contact with their customers, yet collections, that's their job, to have a lot of frequent contact with their customers. So there's a lot can be learned from the organization. The operating model is changing. It's changing because of digital. It's changing because of the speed and veracity and the volume of data and how it's used. It's changing because of fintechs and kind of a fragmentation of the value chain, disruptors, new offerings, new products. Lots of things are impacting operating models, not just are we working from home or are we working in the office, but how far do I work a customer that has a collections requirement, and when do I hand it off to where, and why do I hand it off to where? A lot of that is changing. There will be more and more institutions asking themselves, after they provided a digital opportunity for a customer to auto-resolve, why would they hold on to accounts that need special care, are going to become a stage 3 because it can't be prevented, will have an impairment carrying for life of the product? Why would they not hand that off to a more appropriate organization who focuses on nurturing and facilitating recovery for those customers, and then having those customers back? It's not the core competency of a lender. It is a core competency of a third party, a debt management company, a not-for-profit sector debt counselling service. It is the core competency of those. And I think as these technologies are coming to bear, the operating models are changing, and we're starting to see that. There is performing debt being sold at a greater volume than was previously ever expected. And then the balance sheet. The balance sheet benefits because we manage in accordance with what we have to report on the IFRS 9. We avoid inappropriate impairment holdings because of inefficiencies and ineffectiveness. Our customers are retained better, so we don't have to spend that exorbitant amount acquiring the new customers, because we're much better at retaining the future good customers. And so the balance sheet will benefit from reduced impairments, reduced cost to collect, stronger revenue lines, and lower acquisition costs. So that's what I had to cover. There's been some great conferences and great content around this topic, and there'll be more, no doubt. There's different, the magazines and the media that covers our industry are doing an awful lot of coverage on it. And we at FICO are always here. We've got blogs on the fico.com all around this topic. If you ever want to pick up on the solutions and technologies, enablers and capabilities that allow you to become truly customer-centric, no matter how archaic you might think your IT estate is, or how new you are, and therefore you don't think you'll have a need for anything sophisticated because you don't have the collections volume yet. Actually, we're able to assist many of those long-established legacy credit providers, institutional tier 1 organizations, and help them convert capabilities around legacy architectures and adopt new architectures very easily and very quickly. And likewise, we're able to have low-cost entry points for those that haven't yet got the scale, but want to make sure they're in a good position to retain even just the few customers they're starting to see in collections. Thank you very much for your time.